China's imports of U.S. crude oil have sharply declined by almost 50%, signaling a shift in both the country's energy priorities and the broader dynamics of global oil markets, according to recent data from Kpler. In 2024, China imported only 81.9 million barrels of U.S. crude, down from 115.6 million in the previous year, a decrease of 46%. This drop has caused China to slip from being the second-largest importer of American oil to the sixth-largest, following a major realignment of global oil flows. Several key factors are driving this dramatic reduction in U.S. oil imports, and they reflect China's evolving oil import strategy. As the world's largest oil importer and second-largest consumer, China has traditionally sourced oil from various suppliers to meet its vast energy needs. However, recent reports indicate that China's overall crude imports fell by 7.2% year-on-year, partly due to sporadic COVID-19 lockdowns, high domestic inventories, and refinery maintenance. Despite this drop, China has been shifting its approach to oil procurement, seeking supplies under more flexible and cost-effective terms. Data from Chinese customs suggests that Beijing is deliberately reducing its reliance on some Western producers, focusing instead on securing cheaper oil while enhancing its energy security. China's oil imports are increasingly coming from countries like Russia, Iran, and Venezuela, whose crude is available at discounted rates. The share of China's seaborne crude from these nations has risen from 24% to approximately 26%. While this increase may seem modest, it represents a significant rise in volumes considering China's huge import base, which can exceed 10 million barrels per day. The discounts offered by Russia, a result of Western sanctions, make its crude particularly appealing to Chinese refiners looking for cheaper feedstocks. Similarly, Iran continues to supply China despite U.S. sanctions, using tactics like turning off transponders and engaging in ship-to-ship transfers to hide the true origin of its oil. Venezuela, similarly sanctioned by the U.S., also ships oil to China using complex payment mechanisms, which, despite their intricacies, remain attractive to China's refiners. This shift toward discounted crude from sanctioned countries is driven by a combination of economic and geopolitical factors. Economically, Chinese refiners are benefiting from lower crude prices, allowing them to reduce domestic fuel prices or increase exports of refined products, particularly to other Asian markets. Moreover, diversifying its oil suppliers enhances China's energy security, as it reduces dependence on any single source, thereby limiting its exposure to geopolitical disruptions. This strategy also allows China to strengthen diplomatic and trade relationships with Russia, Iran, and Venezuela, nations eager to find new buyers amid Western sanctions, further positioning China as a global energy power. The movement of sanctioned crude to China is often complex and difficult to track. Firms like Kpler and Vortex use satellite data, port filings, and AIS signals to monitor vessel movements and uncover tactics like turning off AIS transmitters or conducting ship-to-ship transfers in areas like the Malaysian waters. Although some Iranian and Venezuelan shipments may be misreported as coming from other countries like Malaysia or Oman, the increase in these imports indicates a deliberate policy shift by China to take advantage of pricing differentials. Even small shifts in import sources can have significant financial impacts, given the scale of China's energy needs, amounting to billions of dollars and altering global shipping routes. This realignment of China's oil imports has significant implications for global energy markets. The growing share of discounted oil from sanctioned nations challenges the effectiveness of Western sanctions and exposes loopholes in global oil trade. By selectively buying cheaper oil, China can influence global oil benchmarks and market sentiment, especially if this trend continues. Traditional suppliers like Saudi Arabia, Angola, and Brazil are now under pressure to adjust their pricing strategies to maintain market share, further reshaping the global oil landscape. The deeper ties between China and sanctioned oil exporters also have broader geopolitical consequences. As these relationships strengthen, China's global influence as an energy consumer grows, signaling a willingness to engage with nations outside the traditional US-led framework. This not only secures lower-cost energy for China but also boosts its leverage in global trade and diplomacy, potentially reshaping the international energy order. The rise of electric vehicles, EVs, and cleaner energy sources like liquefied natural gas, LNG, could also impact China's long-term oil import needs. As more Chinese consumers embrace EVs and the government supports electrification, oil demand may decline. The growing availability of alternative energy sources further reduces the country's reliance on crude oil, which could influence future global oil trade patterns. China's strategic alignment with Russia and Iran has already reshaped the global energy market, particularly since Western sanctions were imposed on Russia following its annexation of Crimea in 2014 and intensified after its 2022 invasion of Ukraine. In response, Russia pivoted toward China, strengthening their energy ties, with trade between the two nations reaching a record $240 billion in 2023. A key part of this trade is energy, especially crude oil. In 2024, China's completion of the Power of Siberia gas pipeline further solidified its energy relationship with Russia. Similarly, despite U.S. sanctions, China has continued to import Iranian oil, providing the country with vital economic support. As China's energy relationship with these sanctioned nations deepens, it holds significant implications for energy trade with the U.S. The availability of discounted oil from Russia, Iran, and Venezuela offers China attractive alternatives to U.S. crude, reducing its dependence on American oil. This shift reflects a broader reconfiguration of global energy flows and the ongoing evolution of China's role in the international energy landscape. This shift in global trade dynamics is heavily influenced by geopolitical factors as China seeks to diversify its energy sources and lessen its dependence on Western political pressures. China's engagement with Russia and Iran goes beyond just energy trade. It is part of a broader geopolitical and economic strategy. By strengthening ties with these countries, China aims to reduce Western influence and increase its strategic autonomy. This approach is in line with China's Belt and Road Initiative, which focuses on expanding its political and economic power through infrastructure development and trade partnerships. The impact of this shift on the U.S. economy could be significant. A decline in oil exports to China could lead to an oversupply in the domestic market, putting downward pressure on oil prices. This would likely harm U.S. oil producers, possibly reducing investment and leading to job cuts in the sector. Additionally, a sustained decrease in exports could widen the trade deficit and influence broader economic indicators. The shift in trade relations stems from the geopolitical tensions and trade policies, particularly the U.S.-China trade war, which has led China to look for ways to reduce its reliance on U.S. oil. This realignment highlights the complex relationship between economic policies and international relations. China's oil import journey reflects its rapid economic growth and increasing global influence. Over the past 4 decades, China has gone from being a net oil exporter in the early 1980s to becoming the world's largest crude oil importer. This transformation underscores the interplay between industrialization, energy security, and geopolitics. The shift began in the 1990s when China went from being a net oil exporter to a net importer in 1993, driven by rapid economic reforms and industrialization under Deng Xiaoping's leadership. This surge in demand outpaced domestic production, forcing China to turn to neighboring regions, like Southeast Asia, for oil imports. By the early 2000s, as China's energy demand soared, fueled by its accession to the World Trade Organization and economic boom, imports grew steadily, eventually reaching over 4 million barrels per day by the end of the decade. In the 2010s, China's oil imports saw unprecedented growth. By 2017, China had surpassed the United States as the world's largest crude oil importer. This milestone reflected both industrial demand and a growing consumer base. The country began diversifying its sources, decreasing dependence on Middle Eastern oil and increasing imports from Russia and Africa. By the end of the decade, China's imports had reached nearly 10 million barrels per day, solidifying its central role in global energy markets. The COVID-19 pandemic in 2020 disrupted global economies, but China's oil imports remained resilient, averaging around 11 million barrels per day. Strategic stockpiling played a critical role, as China capitalized on plunging oil prices to fill its reserves and ensure long-term energy security. Despite fluctuating imports due to domestic demand and the pandemic's impact, imports reached a record 11.3 million barrels per day in 2023, driven by China's strong post-pandemic recovery. China's decision to reduce or eliminate oil imports from the United States while strengthening ties with BRICS nations, especially Russia and Iran, marks a significant shift in its energy and geopolitical strategy. This move not only reflects China's desire for greater energy security but also its efforts to reduce costs and align with strategic allies. However, this realignment has serious implications for the U.S., both economically and geopolitically. China's pivot away from U.S. oil aligns with BRICS' broader goal of creating a more multipolar economic and political order. Western sanctions on Russia following the Ukraine conflict have presented China with an opportunity to access discounted Russian crude, further accelerating this shift. Additionally, expanding energy imports from Iran gives China diversification across continents, helping to mitigate potential disruptions tied to U.S. trade policies or geopolitical tensions. This strategy strengthens China's energy independence. Economically, discounted oil from Russia and other BRICS countries allows China to meet its energy needs more cost-effectively. Moreover, such arrangements may enable China to bypass the U.S. dollar-dominated global oil market, conducting transactions in alternative currencies, such as the Chinese yuan. This undermines the petrodollar system, which has long been a cornerstone of U.S. economic power. For the United States, the decline in oil exports to China could severely disrupt its energy sector. The U.S. has historically been a key supplier of crude to China, and reduced demand could lead to an oversupply in domestic markets, further depressing oil prices. This would negatively impact U.S. oil producers, squeezing profit margins and curtailing investment. The ripple effects could lead to job losses in energy-dependent regions and slowdowns in related industries, such as logistics and refining. Geopolitically, China's policy reduces U.S. influence in the global energy market. By strengthening its ties with BRICS nations, China is contributing to the creation of an alternative economic framework that challenges U.S.-led systems. This shift is especially important in light of BRICS' goals to develop alternative financial systems and reduce reliance on the U.S. dollar. The loss of Chinese demand for U.S. oil further weakens a key lever of U.S. economic diplomacy and may exacerbate existing trade imbalances, particularly since energy trade has been one of the few areas of positive economic engagement between the two countries. As U.S.-China relations become increasingly adversarial, it will be more difficult for the U.S. to mitigate the economic fallout from this policy shift. That's it for today's video. Thanks for watching. We appreciate your time and support. If you found this content interesting or inspiring, please like and subscribe to stay connected with us. Your support means a lot. Don't forget to check out our other videos on the channel.